I'm Bob Coleman. I run one of the largest private vaults in the country down in Nampa, Idaho. I also run a registered investment advisory firm. I manage a hedge fund in precious metals, physical metals that is, and also provide a transaction service for buying and selling metals, which premium-wise, we've beat every dealer in the country the last 2 years, hands down, saving people $2 to $4 an ounce on silver on most products. And so it's something that, I've been in the business 30 years. So it's one of those things that a great affinity for the client relationship. One of the things I'm proud of is I don't put the premium over the client's relationship. So it's helped prosper the relationship as well as educate people why to get into metal. So I'll get into it's a little bit different format today. I think I do a lot of stuff on Twitter. I put on spaces events where I'm on for 4 hours, 5 hours at a time. So people can interact, ask questions. And I kind of, I'll leave a lot of time for questions because there's a lot of knowledge that I can provide people. But just to kind of get into it a little bit, I thought with the prices the way they are, I thought this would start off as a great therapy session. We'll go ahead and start here. This is just a little bit of background on myself. In terms of what we do, we also not only run a full-service depository, we run logistics globally. We have a facility in Singapore that we store metals in as well. We are fully insured for shipping, for transit. We run an armored car service as well, where we can deliver up to 10 million in metals, even into a residential environment. So we do quite a bit of stuff. Our primary markets are high net worth and institutional business. We work with retail as well. So it's just provide a little bit different tinge on the typical industry. To get in more on my money management side, because I do run a hedge fund, I do monitor the markets. I look at the futures markets. I look at in terms of the OTC markets. There's a lot that I dive into to try and understand what's actually happening with the prices of the metals, as well as market structure, the physical side of the business, what players are doing in the market. There's a lot of insight that I get on an institutional level that I try to feed down to the clients and so forth, just so I can understand and be a little bit more intelligent about what's happening with the markets. This is actually a 50-year chart. I showed this last year. It just shows the outperformance of the S&P 500 over gold and silver. Is obviously, it's kind of hard to see, but I don't know if I can see it pointed there. That right there is silver. Silver is obviously relatively valued to the S&P 500. I'll show you the next slide. It's cheaper now than it was in 1971. But there are periods of outperformance that silver does actually have. And you can kind of see through the years that there are times where silver greatly outperforms the S&P 500 or even gold. So to me, it cycles. And you just got to be patient. And the problem we have in the markets is the paper markets are leveraged, and that leverage creates a lot of volatility and a lot of swings. That tends to wipe people out before the move actually happens. This is a chart showing basically relative value in terms of silver to the S&P 500. It's basically just showing that that it's basically cheaper now to the S&P 500 than it was in 1971. So now this is an interesting thing that I kind of put out there. I don't know if you can see the little dot This was actually Mercury in front of the sun, but there's a little dot right there. That's basically the physical market compared to the paper markets. Paper markets just dominate in terms of trading flow, in terms of just volume, investor or institutional participation. It attracts a lot more capital. And there's reasons for it. A lot of institutions cannot hold the physical metal. They have to hold the security by charter. So that's where the ETFs come into play, or derivative securities and so forth. And that's where we've seen this sort of blow up the last couple of years, especially in the silver, platinum, palladium category under the OCC reports, where you saw Bank of America go from 800 million in derivative products to 25 billion in notional value in 2 years. That's basically what's happening. Now, this is an interesting chart. It just basically shows the positioning of the paper markets. Why the prices are going down, who's liquidating, and so forth. And this last downtrend is basically the ETFs and commitment of traders positioning, which is the futures market. It kind of shows the sort of unwinding of a lot of positions that were taken the last couple of years. It also, I'll get into what's actually happening now, but this has been a dominant factor in the markets here lately, is just the unwinding of a lot of ounces coming out of these ETFs. At the same time, you have resurgence since 2020 in physical coin and bar demand. And this chart is an interesting chart just showing the trends. You're not trying to obviously say, hey, listen, this is bigger than it was last year. You're looking at just trends in the marketplace. We kind of started a downtrend off of the 2013 time period, and then this trend has been resurging, and I think that's basically not just the printing of money, expansion of the balance sheets, low interest rates, that type of thing, but it's also confidence in the system. Because you got to remember, this is physical. This isn't the ETF market where institutions jump in and out of the markets. Now, it's interesting. A lot of people say, well, the ETFs are a dominant force, in the markets. They control the price 100% of the time, which actually isn't the case at all. I presented this chart last year at the Silver Symposium. Basically, it shows in 2008 when silver went from 19 to 9. You kind of saw in blue this chart right here. This is this SLV ETF. Actually, ounces were being added into the fund as the price was dropping like a rock. But the reason why the price was dropping like a rock was the futures market. You had a massive unwind of notional value of ounces being sold on the marketplace. In fact, it was 500,000 ounces worth or 500 million ounces were sold during this time, whereas in the same time period, 43.7 million ounces were being added into the SLV. It just shows the dominant factor that the futures market plays over the paper markets, and it's something I'll kind of discuss a little bit later of how that can actually resolve itself. This is an interesting chart just showing the short positions in the precious metals. This was actually as of July in gold, silver, platinum, palladium. You've had this elevated short position in total aggregate value. I'll get to the next chart, but this is showing you what the markets or participants in the market are actually doing. The sellers are pressing their positions, and the storyline, I guess you could say, is, hey, listen, the Fed's raising rates, they're tightening the liquidity of the markets, they're reducing the balance sheet, so therefore we're going to have a recession. So the playbook for the last 20 years, 30 years has been, okay, let's short commodities into the ground, because at some point, everything's going to slow down and prices will eventually drop. And so you have a lot of activity that's propagating that type of move and positioning for it. Not to say it's right, but that's what's happening. This is more of an aggregate of total value. This is the second largest short. In July, this was the second largest short position in the last 10 years of, if you added gold, silver, platinum, palladium, this, let me see if I can show you here, this little spike up right here, that's the last time the short positions amongst the managed money crowd and so forth were as short as they were was basically at the bottom of 2018. So the market's getting very pressed to the downside here, and you're seeing the potential for negative divergences, or sorry, positive divergences on the price of silver as we broke the July lows today. Relative strength actually didn't follow through. So it could be a sign that the selling is starting to exhaust itself. And those are the things I kind of look at. So it's a little bit more technical. And then there's a little bit of a drop off in August. You had this short covering rally right here. It's kind of hard to see, but you had a big pullback in covering of positions. That's typical when you have these violent short covering rallies. It sort of sucks people into the market, thinking the bottom's in. But all that's happening is short players are trying to, they get squeezed a little bit to the upside. Liquidity dies down. So when they do start to cover, it presses the position upwards a little bit more violently. These are the sellers. It's basically CTAs. These are commodity trading advisors, hedge funds that are basically playing on paper the gold and silver markets. They're not shorting physical silver per se. It's all basically prices, spreads, options, swaps, that type of thing. They're just trying to game the system to try and make profit. It has nothing to do, you look at these kind of charts, and from, on every 6-month basis, it's just squiggles in the market. It's noise. Obviously with physical metals, we're more situated and looking forward to the longer term effects of the market prices, not necessarily the day-to-day stuff, but this is what's actually moving the markets on a daily basis. And I know we did a presentation last night about the conspiracy theories of market manipulation and so forth, which Jeff Christian and Matthew Hunter did a great job trying to explain a little bit of the market and the participants behind it, as well as myself, to kind of get more into the weeds of why the markets do what they do, some of these massive volume surges that we see in the middle of the night, what actually causes that. And I can go through that if you have questions. But this is just showing the massive short position that's been built amongst the managed money crowd that tends to chase the market. So they get very large positions when the market's at tops. Basically, this line right here is when they had the sort of that the price squeeze. But you see the green is the positioning, and you can see that they're trend followers is basically what they are. So as they're now getting very, very short, that provides a lot of fuel that when this market starts to form that bottom and starts to turn, there's a lot of fuel or pressure that can start moving this market up. Irregardless of physical coin and bar demand, it'll actually be the paper markets that shoot this thing back up. It'll be a reversal, just like in 2011 when you had the big run from about 26 to about 48 or so. A lot of that was a short squeeze in the futures markets that took it up, not necessarily physical demand. This is a commitment of traders reports that I follow. It kind of tells you where the managed money crowd is, where the commercials are, banks and so forth, the swap dealers and so forth. The managed money crowd now is net short the market. The speculators are net short the market. Commercials are very lightly short the market, and the large swap dealers are now net long the market. It's interesting because the swap dealers tend to be contrarian to the markets, so they tend to be really short when the market's near a top and actually net long when the market's actually close to bottoming. The swaps, the dealers, is basically this green line right here, and you can kind of see as they get close to this. There's like a zero line right here, but this green line, you can see that they get almost long the market when you're at the lows, and then they get more negative when the market's at the highs. These are just indicators. I mean, they're not perfect signals, but they're just a tool to follow to try and guide you on where the markets are at any given point in time. And then the managed money crowd, which I believe it's the, it's the green line up at the top. You can kind of see that they were heavily long when the market's on the, these big rallies, and then they get liquidated down and actually start going short near the bottom. You can kind of see the same thing kind of happening here as well. They get caught on the short side, or on the long side, they get liquidated. And it's a game that's played between the markets, and because futures are a leveraged instrument, these people are only in it for the price. They're not long-term holders in the markets. The futures market just isn't designed as a long-term investment vehicle. Sort of what we do, for clients, I'll take the time to try to educate them on the markets. This is an illustration of what I kind of see with YouTube and social media and other players that may try to educate people in the market, but they just put out misinformation. So I kind of have this little slide where basically this is what, after I listen to some of these podcasts and so forth, it's like brain damage. And so what I try to do is just try to educate people a little bit more to give them an understanding of actually why the market acts the way they do, and then how to maybe position your portfolio or your expectations, which is more important. Because that way, when the market takes these dives, it doesn't become a depressing moment. And then this is I did this slide last year, just talking about the premiums. That it's one of the problems that the industry has had the last couple of years, and it's not just the retail dealers. The wholesalers have had their hand in it too, in terms of these massive premiums. I've talked to high net worth investors. I get calls from everywhere globally, and the last couple of years, it's been a very frustrating ordeal because a lot of people have just, after they made their purchase, they said, I got to protect my purchasing power. It makes total sense. Sound money. Yeah. They go and buy their first batch of gold and silver, and they feel great about it. And then they realize after talking to me, or they do a little bit more research, that they vastly overpaid in terms of premiums. I mean, it was in 2021. People were paying $5, $50, $6, $7 over spot for silver rounds. I was selling the same thing for $225 over spot. It made no sense why they were charging as much as they were. And it's frustrating to watch that, because these are the same people that are saying, I'm not coming back. It makes no sense to try and make back a 30% return just to break even to overcome these premiums. Now, what you are seeing in the market now is premiums are starting to pull back because the retail inventory, or retail, as their dealers, their inventory levels have been rising or becoming more stagnant. You're not seeing the movement of metal happening. You're seeing in the markets, you're seeing the size of the trades are larger, but the number of trades are decreasing. So you're seeing larger investors coming into the market buying, but you just don't see the retail environment, which is pretty typical when you get near the lows. It's you get a rush when you get a buy in the dip, but when it stays down like this over time, you just lose momentum of the crowd. And that's what you're kind of seeing. So from that standpoint, I think to get people more interested in the markets, and it's something I've been saying for a long time, there has to be a different structure. You have to have maybe more transparency in pricing, better pricing, to make it more enticing for people to say, hey, listen, if I'm going to buy a coin or a bar, I don't have to overcome these massive premiums. And then the other problem you have, which I talked about last night, is you have the spot price. What is actually the spot price? A lot of online dealers have their own version of the spot price, which is 20 cents, 30 cents more than the actual spot price. So then the clients understand, well, they start to see this. And I have people that are telling me, they're like, this doesn't make any sense. I go on someone's site and it's like 30 cents higher than what I see like in the London interbank market or the COMEX or whatever it may be. So people are starting to catch on that, they're being fleeced a little bit. And so, and that's something that I've been trying to educate people on is, it's caveat emptor. Do your homework, search around. Don't trust the guy that you listen to on YouTube. Make several calls or try to look at different types of dealers. This just talks a little bit about us in terms of, I've been in the business 30 years. never had a client complain on my record. We try to do really a full service type of operation where we try to educate the client, get the best prices for them, but try to guide them into getting more ounces for your money, not necessarily the right product. And it's something that I think when people start positioning themselves in the market, ultimately you want to try and do what's best for yourself, not necessarily what the dealer says what's best for them. And that's something that, I run a little bit different operation in terms of I deal directly with wholesalers, so we don't have to hold inventory, hedge it, carrying costs, all that type of stuff. I buy directly from them when I need it, and then I mark it up very little, and then I just basically can either drop ship or we store at the facility. This is Idaho Armored Vaults. This talks a little bit about what we do. Our website is goldsilvervault.com. We do a lot of different things there in terms of full service operation. We do, like I mentioned earlier, we do armored transport. We can pick it up from the client's house anywhere in the U.S. We can drop it off. We've looked at redundancy in the system, expecting that when 2020 happened and COVID and the shutdowns and all that kind of stuff, we prepared for all that. Our vaults are EMP proof. We can move metal outside of traditional UPS, FedEx type logistics programs. We do international shipping as well. Bring the metal into the country, helping the process of custom clearing, that type of thing. We have the relationships to work with that as well. So what we've been seeing, for example, lately is with COVID and so forth, is a lot of people repatriating their money outside the U.S. back into the U.S. because we have a store in Singapore, and we've done that since 2011. We're one of the first operations that actually set up with Malka Amit there. Actually, it was 2 months after J.P. Morgan started storing their metals. But it was actually, Singapore still had a goods and services tax on precious metals at the time. But now we're pulling metal out of there because the market's dead. No matter what you hear from dealers online or on YouTube, Singapore is very, very quiet. The bids are very, very soft. The shipping used to be 30 cents an ounce to ship to Singapore. It's gone to $1.50 to $2 an ounce, $2.50 an ounce. I mean, it's crazy how much the costs have increased. So it's dissuading people from not only shipping there, but now when they're transacting, a lot of wholesalers, U.S. wholesalers when we do transactions in Singapore, they're having to lighten their bids because they're going to end up shipping the metal back. And so these are things that I get into to try and explain to people, why international storage is maybe not the greatest thing in the world, because you got to look at the exit strategy. The idea when COVID happened turned everything upside down. The idea of getting on a plane and going to that location because everything's going to hit the fan here in the country. Well, we just saw that any country can shut down everything. So, and the U.S. It's interesting. Maybe because I'm in the U.S., but we're still the safest place in the world to store metals. Even though there's this idea of confiscation and so forth, which I don't think will ever happen because we're not on a gold standard anymore. There's no need to actually enforce that policy. They can do it through taxation and inflation. The issue with when you look at the intricacies of moving metal into the United States versus other countries, you could bring $1 billion of gold into this country as long as it's not China or Russian bars, I guess, but China has a 25% tariff. You can bring it, and it'll cost you $528 total in customs fees. You can't do that with most other countries. It's a very open still market in terms of customs and so forth, and it's a politically safe jurisdiction. Idaho, I feel like I'm a little bit biased, but I think Idaho is, one of the better states to store. You don't have a usage tax, you don't have a sales tax, you don't have a value-added tax, goods and services tax, whereas other states do charge sales tax on the entire purchase. And so it allows, you're trying to, again, guide the client to keep more ounces in their pocket and reduce regulatory exposure, that type of thing. Idaho Armored Vaults, I think we're the only facility that doesn't require a tax ID number or social security number to establish an account. We don't have any reporting requirements. So it's privacy oriented. Again, I've been an investment advisor for 30 years, so I understand the framework of KYC, know your client, as well as anti-money laundering policies. We have those in place, but there's ways to structure to protect clients' assets. And one of the things that's bringing people into the market, bigger high net worth individuals, it's not necessarily the price, it's the concern about political policy, the tax policy going forward, social policy. It's the idea that, my state, 10 years from now, is it gonna be taxed to death? And so it's this sort of return of your money concept instead of a return on your money that is driving people into the precious metals from a asset allocation standpoint. And they don't really look at price as much. It's not as a dominant force of, hey, listen, I'm gonna make a killing in this thing. They're more worried about preservation of capital. And it's one of the things I kind of talked about on that video with Rob Kientz last week was, I think the industry needs to shift its sort of view from silver as money to silver as private property, because there's very few assets left that are bearer form, that aren't regulated. You don't have to annually register, or you have in a financial account that even just establish the account, you have to basically hand over, your birth certificate or, all this type of information. So it provides, I think that's the way that the industry, at least in my opinion, needs to maybe go after to try and educate more of the masses that, there's a reason for the metals. It's maybe not necessarily that's going to turn into money magically, but it's actually property that can actually be handed from person to person or just kept, on your purse, so to speak, without any type of government involvement. Let's see this. Now, I could take questions now, or I could get into physical storage, all the risks that people need to look at if you're looking at ownership versus, this gets into a little bit more of the reasons why, not only just to look at physical metals, but also the programs, the structured programs that are in place. And to understand, because I read all the storage agreements out there, I read the user agreements, I read, the COMEX, we've taken delivery from the COMEX, delivery from most programs around the world. So I know how a lot of them operate intricately. I have a lot of like Sprott's PSLV, you see a lot of this sort of support for some of these structured products because they sound like they're going to fight the system, but in reality, there's a lot of dilution that goes on, a lot of extra premium you're paying for that you may not be seeing. So what I try to do is break down physical ownership versus representation of price or representation of metals. And so there's a lot of programs out there, pooled programs and so forth, balance sheet financing operations. There's not to name names, but I've been on Palisade Radio talking about certain digital programs and the arrangement that's in their user agreement that's extremely one-sided, that's benefiting the sponsor, not necessarily the client. These are things that I get into to try and educate high net worth individuals to make the choice that's right for them. Explaining what pooled funds are. I've been doing that since 2010 in terms of trying to explain to people, what's in their best interest, in terms of ownership, possessions, 9/10 of the law. That's, I keep it simple. And so I look at that type of stuff. And so I start to explain to people allocated versus segregated storage. There's a huge difference between the two. Allocated storage, it can get as simple as say, hey, listen, I have 10 clients or 10 people that own one 100-ounce bar each. And the dealer can buy a 1,000-ounce bar and represent everybody in that metal with that 1,000-ounce bar. To basically allocated storage could be, hey, listen, you buy a bunch of Silver Eagles, you get all those Silver Eagles are thrown into a pile with everyone else's Silver Eagles, you'll get back Silver Eagles, and it's not necessarily the same ones you bought. I mean, there's different ways to create, this allure of allocated storage is the best form, but segregated that's all we do at Armored Vaults is your assets are physically separated from everybody else's in the facility. If you walked into our vaults, they're basically, it looks like Raiders of the Lost Ark at the end of the movie when you have all those crates and so forth stacked up everywhere. That's basically what we do. But it's explained to people. Again, you see a lot of gold dealers getting into the storage business where they set up accounts like at Brinks or Loomis, and they're basically master-sub relationships where the client doesn't actually have any relationship with the depository. It's all through the middleman. So if they want their metal, they have to go through the middleman. That creates second tier issues because at that point, you're in a system that's a closed loop system. If you want to sell your metals, you have to go through that dealer, and that's whatever that dealer's quote is at that time is what you're going to get, unless you want to take delivery. And if you want to take delivery, it's the price that they want to charge you on top of what Brinks is going to charge, for example, for shipping, because they're going to make money off of every transaction. So it's understanding that. And that's why I always tell clients, have a direct relationship with the depository, whether it's us or Brinks or IDS or any of the depositories out there. That way you have control of your metal. You can sell to anybody you want to sell to. You can take delivery of it, but the instructions come directly from you to the depository. It doesn't go through a middleman. And we kind of saw some of the issues with COVID in 2020 where it was difficult for people when everything hit the fan. People calling me saying, listen, I want to get my stuff out of such and such program, but I can't get a hold of them. And these programs aren't designed for delivery. The industry is not designed for delivery. And I recognized that back in 2008. That's why I started my own depository. You have 20% of people that want to get out of a major program. They don't have the manpower to handle that wave of demand. And that's, I see that. It's something that it's the Achilles heel of the entire industry. In fact, that's the Achilles heel of the entire financial system. And that's why I promoted the idea of take delivery of your metals, whether it's to your house or to a depository. Because we do take delivery from the COMEX. We have pulled a lot of metal from them. We try to educate people that it doesn't take a rocket science to figure out how to do this stuff. In fact, we work with wholesalers that break receipts, right, that they have with the COMEX, and they break those receipts, get the bars, and then I basically turn it into a cash and carry. So we can have a direct impact on the market. And it's the 1,000-ounce silver bar market that really dictates the price. And the trading that you see on a daily basis, we did this last night. We went through a very good presentation, but Jeff Christian had a slide basically back in 2021 in January, took 3 different examples, and there were 3-hour breaks in time, 3 and 4 hour breaks in time of the amount of volume that goes through the COMEX in terms of trading of futures contracts. In one instance, there was 350 million ounces traded in 3 hours. In another instance, in 4-hour time frame, there was 550 million ounces. You're talking half the world or a third of the world's entire production traded in a 4-hour period. I mean, it has nothing to do with physical metal. It's all price because you have the reason why the futures markets gravitate a lot of people to them is because they're given leverage by the clearing firm, so they can put down 10% of capital to control, however many ounces, and they're playing for movements in price. That's it. The key, though, is if you pull the metal from the system, it starts to deleverage that effect. So people that are maybe shorting the market down, if they don't cover, for example, or maybe the market starts to turn against them, it will force their position out if they're not hedged. And that's what I envision. It's the only way to sort of, I don't want to say break the system, but it's the only way to level out the system is the demand for physical. And we've been seeing that. I've been on top of this since 2020, trying to explain to people why all this metal came onto the exchange back in between March of 2020 to August of 2020. You had a massive amount of metal come onto the gold market, to the silver market, and a lot of that was funds, refiners that were taking advantage of arbitrage. You had this massive deleveraging that was going on. And now you're seeing with the market being pressed lower and lower, metal is leaving the exchange. And in fact, a lot of that metal in the silver market is being pulled, it's going to the US Mint. These guys are making a lot of silver eagles. I mean, they're creating a war chest. This last 5-10 million ounces have been, from what I understand, is going to the Mint to build their war chest for the 2023 Silver Eagle program. They're starting in October to make sort of a war chest, I guess you could say. But that's where again, you look at the markets, you look at the premium structure for Silver Eagles. Yeah, that's probably the worst product to buy right now because the premiums are so high. But it may be where the mint is actively looking for another partner to make more blanks, and that may equalize the price of Silver Eagles. Maybe 6, 8 months, a year from now, and that premium come down. That'll be the time to buy it. So what I try to tell people is, buy a better premium product right now to get more ounces for your money. You can always do a swap later. And then in terms of risks of the system, I looked at, at the facility, I looked at everything. In terms of, I can go through a litany of risks there that we have here: leverage to the financial system, debt issues, liquidity, asset bubbles, all that kind of stuff. Well, the reason why I think a lot of us buy silver and gold is the idea that, if everything kind of comes disjointed, at least you have an asset that you don't have any counterparty risk to. And that's, to me, again, it goes back to return of your money versus return on your money. And then looking at custodians and sub-custodians, I kind of go through this stuff in terms of, we fully insure all the assets that we store, through our $500 million all-risk policy through Lloyd's of London. But a lot of facilities don't insure their full exposure. It's actually very common in the industry that they don't. It doesn't, it's costly to fully insure all your assets. I'm just one that comes at this from a fiduciary standpoint because I'm a registered investment advisor. So I say to myself, I don't want the risk and exposure, so I'm going to pay that extra premium to make sure that I don't have the exposure, and that protects the client. It makes total sense to me, but you see a lot of these facilities that may have $1 billion all-risk policy, but they store $3 billion in their facility. And you see a lot of that with COMEX facilities. Oh, just to go back on this, and this is one of the things I talk about, we talked about last night a little bit with GLD, the reasons for ETFs and so forth versus physical metal. I can get into that. It's a whole other subject. But the LBMA has something interesting with regard to the rules on sub-custodian risk. If, for example, if JP Morgan is storing the metals with a custodian, the custodian says, listen, my vault's filled up, I got to go and find a sub-custodian for these bars of gold, silver, whatever it may be. The sub-custodian loses all their metal. In London law, basically, there's no recourse between the custodian and the sub-custodian. The sub-custodian is actually, they have hold harmless, basically, clauses. And I thought to myself, why is that the case? Because it doesn't make any sense. And it started to dawn on me that the sub-custodian, in most cases, is the Bank of England, and you can't sue the Bank of England. So that's why it's probably in there. Again, offerings and agreements. I always tell clients, don't listen to the advertising. Don't listen to the sales marketing on a YouTube or an interview. Read the agreement. I see a lot of this, and I pointed it out on Palisade Radio, where I've had literally within 2 weeks, a program changed their clauses because I pointed it out. I've done this numerous times, but it ends up giving them sort of a free look, of an expert reviewing an agreement. But I just want people to be protected because we look at this idea of a disjointed system, but what happens if you're in a structured program, to your metals if the program actually fails or runs into issues, or like lease rates are going up right now because you have, and I can get into the backwardation issue of the markets because CTAs are shorting the futures market so much. The physical demand for product is steady. You're seeing this odd backwardation where the physical price, spot price, is more expensive than the futures price on the next lead month contract. And you've seen this kind of develop since June. So it's telling me that this pushing down in price becomes almost like a coiled spring, because if demand continues to stay strong, the futures price can only get pushed down so far until either they're forced to either come up with metal or they start closing out their contracts. If they start closing out while the commercials are actually very, very lightly short, that could create a liquidity squeeze to the upside. And that's sort of what I'm watching for in the markets. This idea that the market goes down and down and down until it finds equilibrium. And you use technical analysis to determine, okay, when's this resolution going to potentially take place? When's the exhaustion going to happen? All that kind of stuff. That's what I kind of do. So, I could get fee discrimination. This is basically IRA companies that have relationships with some of the depositories where they have massive fee structures that are totally discriminatory to IRA accounts versus private accounts. It's another reason why the industry underinsures their metals, because of the fees that they charge for some of these IRA companies. Is they can't probably even pay the insurance contract on it. Again, this is methods of storage: unallocated, allocated, segregated. Just to kind of explain the differences between the two. It's something I try to, again. It sounds great, allocated, but it's just understand exactly what it really means. And again, this is relationships with the vault, direct versus indirect. It could just have the power of avoiding that third-party relationship and just dealing directly with the depository. Again, counterparty risk and so forth, conflict of interest. Storing your metals at a dealer. There's you got to remember they make their money on the transaction, not necessarily the storage fee. So you see a lot of this with regard to giving away the storage rates. There are clients that or companies that are 20 basis points cheaper than us, but when it comes to us, the savings on the transaction pays for 5 to 8 years worth of storage fees compared to what they would have paid on transaction fees with the other company. And I try to educate people with that. Don't just look at one fee over the other, look at the entire transaction. Again, this is, read your documents, that type of thing. Transparency and going concern, it's a big problem because the physical markets are completely unregulated, except on a state level, and the states don't really have the manpower to look at every facility out there. They're a very limited staff. So try to understand. I've seen where depositories come into play where it's very common that you see the gold dealer own the depository. But you're signing the agreement with the depository. So then the depository really doesn't have any assets. So what happens if there's an issue? You're dealing with a subsidiary that basically there's very little recourse that you could have. But it's trying to just understand that relationship. Foreign storage for U.S. investors, what to look out for in terms of. This is a little bit more regarding Form 8938 and the FBAR, how you actually store your metals overseas. If it's with a dealer that, quote, has a depository, but when you sign that agreement, if it's a dealer you're signing the agreement with and not necessarily the depository, that potentially can become a foreign financial account. You then have to declare that to the United States and on Form 8938 as well as the FBAR. If you don't, there's tons of fines and penalties. So again, understand that relationship. And this is foreign investors looking at U.S. storage. The confiscation issue, I kind of touched on that. Privacy, I think, is a huge thing. Capital controls. The idea of, you talk about the central bank digital coin scenario. The idea of capturing or captivating each transaction for tax revenue purposes. So the government can be more efficient in collecting your money. If that happens, the concern is that we become into a more Big Brother environment. It's one of the risks I looked at with regard to socialism and fascism, political risks, all that kind of stuff. It's again, that's why the metals kind of introducing it to the public as private property. I think there's a reason to actually sell it as private property versus money. This kind of goes through the political stuff in terms of, again, it's funny because this slide I actually created back in 2011 when I was doing a presentation and I had travel restrictions and I didn't think COVID was going to do as what it did, but I just thought that was kind of interesting. Force majeure, a big topic, not only on Wall Street. You had the cancellation of trades we talked about last night in terms of the nickel trade and so forth. But the idea of force majeure is basically when something is out of somebody's control. Try to understand, we even have that in our clause, in our policy, because we do a lot with pulling metal from the COMEX. So if the COMEX says, listen, we're not going to deliver, that's something we have no control over. But just try to understand the limitations of delivery in the contract. Again, delivery, ask programs, besides FedEx and UPS, what other types of contingencies they may have for getting metals to and from the facility. Yeah, we looked at social chaos. It's one of the reasons why I liked Idaho, in terms of it's away from high population areas and so forth, lack of crime, that type of thing. But it's another risk that you kind of have to kind of consider. Authenticity of the product. I'm not a big believer of buying stuff on, Craigslist and flea markets, but we have clients that do. So we actually will test products as they come into the facility, especially if it's coming from an individual. We'll test every single round, every single coin, to make sure if there's any issues, we can bring it to their attention right away. Again, this is interesting clauses in the contracts, hold harmless, limits the liability clauses, that type of thing. This is just some of the phrases that have been in storage agreements that I've seen. I've seen customers or programs say, hey, listen, we provide allocated segregated storage, but in this agreement, it has nowhere in the word segregated. So, just try to understand the differences between marketing and actually what you're signing. This one's kind of interesting right here. This is actually coming from the Texas Depositories storage agreement right here, which is an immunity clause that if something happens to your metals, you have no recourse because you can't sue the government. Some of the things sound great on paper, storing in Canada at the Royal Canadian Mint through Sprott. Hey, that sounds great. But like we just saw what Trudeau did earlier this year, their political structure is a lot different than ours, our parliamentary government. So, and the Royal Canadian Mint is a arm of the Crown Corporation. So things can happen and you got to be prepared for it, but you got to understand where you're storing. Accessibility, flexibility, that's one of the things that we really look at. It's one of the early things I tried to when I created my facility and system, is what's actually best for the client. This is actually a slide from last year in terms of demand for delivery. I talked about Basel III at nauseum. I wrote stuff on Twitter about what it actually meant. You had a lot of people on Twitter talking about Basel III is going to take silver and gold to the moon. It's going to force all the short covering. And basically what Basel III is doing is it's deleveraging the system. It's basically sending risk to what they call qualifying central counterparties, like the CME exchange, and moving the unallocated type of products that banks traditionally did. It disincentivized them. So, and that's partly one of the reasons why I think you've seen this explosion in derivative activity, derivative securities, because that's underwritten more on their investment side. But it's understanding the markets of what some of these things actually mean. So you don't get disappointed if the market doesn't go from $20 silver to $100 silver in 6 months. Let's see. And that's basically it. Again, just trying to help educate people. I can get into a lot of different topics. We can get into the Fed, reverse repurchase program, the massive $2 trillion they have there, why what I see with the markets, this massive supply that's coming in terms of treasury debt, and who's going to fund it. I mean, I can get into a plethora of different things. So if anyone has any questions. One of the big differences between funds and physical metal owners is we look at this as a zero-sum game, I guess you could call it. It's the funds look at it from a profit percentage or a profit situation. 4 minutes? Okay. So with the funds, they're just looking to gain trend and to capitalize on that trend. It's not necessarily they're long-term oriented. I could go back to the chart and you see the squiggles and them moving in and out of the markets. the problem with the futures market is it's not a long-term vehicle. It's designed to capture a point in time and a profit in a point in time. That's their goal. So you have enough. Everyone's trying to read the tea leaves, I guess you could say, and the tea leaves right now are saying, hey, the Fed's trying to cut liquidity, try to reduce the balance sheet. And then as physical metal owners, we're saying, my God, we look at the federal government and they're starting these stimulus programs up again, and they're going to have to try to help the economy along. And you get this dichotomy and stress in the system. And that's what sort of helps. That's why you see some of these issues like backwardation, where the physical market is more expensive than the lead month futures contract. And you try to understand that doesn't happen all the time. In fact, it's more rarer than the norm. And that's it's something to watch for. It doesn't say that means the price is going to go up. It just means that you can push on that spring as much as you want, but at some point, if people start taking enough delivery, and I think we're close to 50 million ounces left in the registered category, that's going to continue to draw down. And you're seeing refiners pulling metal off the exchange and sending that metal back to Switzerland, for example, with silver and gold, to make product. Mining activity has slowed down. Prices have pulled back. Summer is a little bit lighter in terms of production. And so it's getting, from a sourcing standpoint, the COMEX, which traditionally isn't really always the greatest sourcing because it's a little bit more expensive, that's where refiners are getting some of their metal, and that's creating pressure. And again, you have the CTAs, which are playing paper, and you have the physical world, which is pulling metal out at the same time. Eventually, you're going to get that dislocation. From what I understand, the Mint is looking at more ventures to make more product. And and I think if you see. You see another facility or refiner kind of take the reins here and add a more production, because you got to look at the Silver Eagle production is half of what it was 10 years ago, and it's just odd. Why is it half? I mean, you have Sunshine Mint, which has now a facility in Las Vegas and also in Coeur d'Alene, but they're making half as much product, and there's a lot of people that throw even their conspiracy theory on, who has a 45% interest in Sunshine Mint. It's another huge wholesaler who's a direct distributor for the U.S. Mint program. And, you see a lot of this worry that, well, they have influence over how much production is made, because if they can influence that production, the private proprietary products that Sunshine Metal makes for them, private label products, they can charge more for those premiums. And it's because everything is focused off the Silver Eagle because it's one of the most popular products. I mean, there's a lot, and you look at that company's stock, and it's gone through the moon. I mean, so there's a lot of conflict in this industry, and it's a very small industry. There's a very few players, but it's something that I think the Mint has taken notice of, and they're getting a lot of flack for it, and that's why I think they're looking at other partnerships. But I think if that happens, the premiums will get cut in half, and that's why. I mean, we did swaps out of Eagles into 100-ounce bars for clients a couple weeks ago because I think the premium probably topped. I think you can only charge so much when you're at $17 or $18 silver. It just doesn't make any more sense. And I think the market will kind of readjust this entire evaluation, because you can go into other sovereign products and just get a lot better price. And the premiums are coming down. I mean, the sovereign products are you have Austrian Philharmonics, which are sub $4 now, $3.75 over spot, even $3.50 for very large size orders. I mean, you're seeing premiums because dealers aren't moving product, and that's going to force some of that restructuring. Oh, we're up. Oh, so, I can answer those, I guess. I'll get. Because it was basically a little bit about last night's presentation with the paper and physical volumes and how that dominates, as well as the movement of physical metal, the demand, who's actually buying this physical metal, that type of thing. But I can talk to you about that. So, yeah. Thanks.